Universal life was created for living benefits. Whole life is primarily for death. In this episode, I'm going to answer the question, what is universal life versus whole life insurance? Frankly, I ought to know. I've been doing this for more than 46 years, so get ready. You're going to understand some differences that many life insurance agents don't even understand. So my name's Doug Andrew. I've been a financial strategist, a retirement planning specialist for more than 46 years. Generally speaking, when people prepare for retirement and then retire, they draw retirement income from maybe 4 different sources. A lot of people have way too much money at retirement in yet to be taxed IRAs and 401ks in the market. And I go, what are you thinking? And so I have to do a strategic rollout from their IRAs and 401ks to get the taxes over and done with sooner than later and put it into an environment where they earn tremendous rates of return when the market goes up, but they don't lose when the market goes down, because if your money's in the market, you can't create predictable cash flow. See, the market, Wall Street, was designed to have your money stay there forever. If you ask a stockbroker or an asset manager, when is the best time to sell and liquidate my stocks? They will say, never. The purpose of accumulating money is to be able to take distributions. So at retirement planning is oftentimes way different than maybe what you did for retirement planning. What I do with a lot of clients is I help them transfer 40 to 60% of their income during retirement to totally tax-free income, where they can earn 6 to 10% rates of return. And this is best achieved with maximum funded indexed universal life insurance because it was designed for living tax-free income benefits. Whole life insurance can do it, but it's usually at about half the net rate of return because whole life was designed primarily for death benefit. You can use it for living income, but the income is much lower. They're not as flexible as universal life policies. You can fund universal life faster and put in more money. You can tweak the rate of return so that if you earn a 9, you net 8, you earn 11, you net 10. With whole life, it takes you your whole life until age 95, that if you earned 8, you would barely net just under 6. My heavens. I can net 8 easily. I've been doing that for 46 years with Universal Life. My favorite vehicle is Maximum Funded Universal Life because it was designed in the first place by E.F. Hutton for living benefits, to use it for tax-free income, whereas Whole Life has always been really first and foremost for the death benefit, and it has certain tracks you run on with the guarantees. And so if all you need is death benefit, you can accomplish that with Whole Life or Universal Life. But if you want something that's universally applicable, where you can use it not just for death, but also for life, or maybe primarily for living benefits, by far, I would choose the universal life over the whole life insurance. So let me explain why and some of the differences. So let me tell you a little story. For 4 years, I had over 3,000 CPAs, tax attorneys, financial advisors, insurance agents, real estate agents, all kinds of professionals in the financial services industry come through an intensive 3-day training on how to optimize assets and minimize taxes. And I had many of the nation's top whole life insurance agents. They won awards for this. And they were selling whole life insurance with some very reputable companies like Northwestern Mutual and Mass Mutual and so forth. And they would come because they had been sort of indoctrinated. They had these blinders on and they said, you know, Doug, our whole life insurance has had an excellent dividend paying history. And so I'd say, well, what is the history? Well, you know, close to 8%. Now, they haven't been doing that recently, but let's just say 8%. I said, I want you to show me what the best net internal rate of return is on a whole life policy. If somebody started one out at age 30, 35, up to age 65, retirement, and then age 95. Now they went, internal rate of return, what do you mean by that? They were never taught it. Because their head, their agency manager did not want them to even understand what internal rate of return was. What is it? That means cash on cash. After all costs are taken out, if I put this much money, $10,000 a year, $100,000 a year, $1 million a year into a whole life policy versus a universal life policy, and you are using it primarily for the living benefit, okay, tax advantaged income in retirement, you take the least amount of insurance the IRS will let you get away with. Right off the bat, universal life, if I wanted to put in $500,000, I can get that in 4 years and 1 day in a universal life. A whole life takes 7 years. I can put the money in faster so it will grow to a bigger sum quicker. I can get away with less insurance. I can reduce the cost of the insurance down on universal life that I can't on whole life. In other words, my goal is to, if I earn 8, I want to net 7. If I earn 9, I want to net 8. If I earn 11, which I've earned many years, I want to net 10. I want the cost of the insurance that the IRS says has to be there or it won't be tax-free. I want it to drain out 1% or less. You can't do that with whole life insurance. See, what I want to calculate is if I put in $500,000 and it's earning 11 and netting 10, I want to have the cost of the insurance only drain out one of those percentage points. Now, when I say that to a whole life agent, I say, so what's your internal rate of return? And they go, 8%? I go, no. Well, how do you calculate it? So what you do is you take, this is a complicated calculation, you take the premiums that you paid in, and sometimes they're sporadic in different amounts. With whole life, they usually require you must pay a certain amount. Universal life has all kinds of flexibility. I mean, I can put in $300,000. I don't have to put in anything for 10 years if I don't want to. You can't do that with whole life. You have to keep paying a certain amount. But if I put in $30,000, I can put in the other $270,000 anytime. And so there's more flexibility with universal life. But basically, when I put the money in, then you calculate, so based upon these deposits, premium payments, up until age 65, how much cash value do you have? Well, that's easy. They go, well, you would have this much cash value. That's the money inside the insurance policy. And so you back into it and say, what rate of return would you have to get to end up with that much money? And all of a sudden I did that, and it was like at 8%, they were only netting 5%. And I go, you're really only netting 5% after the cost of the insurance. And they went, I've never calculated that before. They never taught us this. Well, so what's your universal life policy doing? I'm going, well, if I earn 9, which I have been earning, I'm netting 8. If I'm earning 11, I'm netting 10. And all of a sudden they'd get this big aha moment. And I'd say, so when does yours go down to the smallest amount? And even some of these very reputable companies that they were assuming would pay 8% dividends, it took until age 95 at 8% before they would net 5.95, let's just say 6. You had to wait till you were 95 years old and earn 8% to net 6. And I'm going, I only have to earn 9 to net 8 tax-free in a universal life, and that happens within 10 or 15 years into the policy. And that's when they would go, oh my heavens, I didn't know what I didn't know. Why is that? Because universal life has more flexibility and allows you to put in more money and squeeze down the cost of the insurance very, very low. Whole life, you have a certain track you run on in order to meet those guarantees, and it takes forever to have your net rate of return come to within 2% of the gross rate of return, 2 percentage points, maybe even age 95. So let me ask you a question. So let's say your primary goal is to not outlive your money and have the highest net spendable income. So that means every $1 million of cash value inside of a whole life policy versus a universal life policy. In a universal life, based on actual historical rates of return, when you maximum fund it, I can generate $60,000, $70,000, usually $80,000 to $100,000 a year of tax-free income from age 65 to age 120 without depleting principal. I would dare you to show me a whole life policy that can come close to providing that kind of income. A whole life agent may say, oh, well, based on guarantees, we can give you $40,000 a year of income. Well, what would you prefer, $40,000 or $80,000 or $100,000? How much more is $80,000 than $40,000? Twice as much. So in that situation, The universal life generated twice the income to age 120, and you can put in guarantees and no lapse guarantee riders and so forth. You can have that similar type of guarantees that maybe whole life agents say, oh, but whole life has these guarantees. Well, they charge you an arm and a leg for those guarantees with whole life. And so what are you paying? You're giving up half of the income you could have been getting. You could have been getting $80,000. Instead, you only have $40,000 because you want to be guaranteed that it will never lapse. Well, I can basically accomplish the same thing based on actual history with a universal life. So in summary, a max-funded indexed universal life insurance policy was primarily designed and created for living benefits. You can put in the money faster. You can get away with less insurance. You can keep the cost lower. They're more flexible as far as putting in a ton of money and then coasting for years without adding money. You have all kinds of additional benefits for a universal life policy. Whole life, you just sort of you have to go down a certain track, so to speak. Now, if this is intriguing you and you want to learn more, please click on the link below or take advantage of reading this book. This is my 11th book. It's a bestseller, The Laser Fund, How to Diversify and Create the Foundation for a Tax-Free Retirement using max-funded IUL. I call it the Laser Fund. Laser means liquid assets, safely earning returns. It's an acronym. It's actually 2 books in one. This is 300 pages. This side is for the left brain thinkers who want charts and graphs and explanations, the engineers. If you learn by stories, you flip it over and read this one. This is 100 pages, 12 chapters with 62 actual client stories. I'll tell you what, this retails for $20. You claim a free copy. I'll pay for the book. You go to laserfund.com, pay $5.95 shipping and handling, which frankly doesn't quite cover that. But nonetheless, I will pay for the book. You pay $5.95 towards shipping and handling. I want you to claim your free copy and begin to learn how universal life can far outperform whole life if your primary goal is living benefits.